Chapter 18. Stock Market Indicators. But there's another class of market indicators widely employed in stock market analysis whose purpose is to determine the health of the overall stock market by measuring market breadth. The data used in their construction are advancing versus declining issues, new highs versus new lows, and up volume versus down volume. However, there were more declining stocks, 1.559, than advancing stocks, 1.327, suggesting that the broader market didn't fare as well as the Dow. The advanced decline line. This is the best known of the breadth indicators. The construction of the advanced decline line is extremely simple. The most common way to calculate the AD line is to take the difference between the number of advancing issues and the number of declining issues. If there are more advance than declines, the AD number for that day is positive. If there are more declines than advances, the AD line for that day is negative. That positive or negative daily number is then added to the cumulative AD line. The AD line displays a trend of its own. The idea is to make sure the AD line and the market averages are trending in the same direction. Fig. The NYSE Advanced Decline Line versus the Dow Industrials. In a healthy market, both lines should be trending upward together as they are here. AD divergence. The Dow Industrials. Fig. The NYSE Advanced Decline Line versus the Dow Industrials. In a healthy market, both lines should be trending upward together as they are here. AD divergence. The advanced decline line tells us if the troops are keeping up with the generals. As long as the AD line is advancing with the Dow Industrials, for example, the breadth or health of the market is good. The danger appears when the AD line begins to diverge from the Dow. Daily versus weekly AD lines. A weekly advanced decline line measures the number of advancing versus declining stocks for the entire week. Those figures are published in Barron's each weekend. A weekly advanced decline line is considered more useful for trend comparison spanning several years. Variations in AD line. Advanced decline line can also be constructed for the American Stock Exchange and the Nasdaq market. McClellan Oscillator. The McClellan Oscillator is the difference between the 19-day 10% trend and the 39-day 5% trend. The oscillator fluctuates around a zero line with its upper and lower extremes ranging from +100 and -100. A McClellan oscillator reading above +100 is a signal of an overbought stock market. A reading below -100 is considered an oversold stock market. Fig. The McClellan oscillator shown as a histogram. Crossing above the zero line are positive signals. Readings above +100 are overbought, while readings below -100 are oversold. Notice the extreme oversold reading during October of 1997. McClellan Summation Index. The summation index is simply a longer range version of the McClellan oscillator. The McClellan summation index is a cumulative sum of each day's positive or negative readings in the McClellan oscillator. Whereas the McClellan oscillator is used for short to intermediate trading purposes, the summation index provides a longer range view of market breadth and is used to spot major market turning points. Fig. The McClellan summation index is simply a longer range version of the McClellan oscillator. The summation index is used for major trend analysis, crossing below zero and negative. The February 1998 signal was positive. Fig. A 10-day average of new highs versus a 10-day average of new lows. A healthy market should see more stocks hitting new highs than new lows. During October 1997, the two lines almost crossed before reasserting their bullish alignment. New high, new low. Index. The advantage of a new high, new low index is that it can be directly compared to one of the major market averages. Dr. Alexander Elder describes the new high, new low index as probably the best leading indicator of the stock market. Fig. The new high, new low index versus the NYSE Composite Index. This line plots the difference between the number of stocks hitting new highs and new lows. A rising line is positive. Notice the sharp drop during October of 1997. Upside versus downside volume. This is the third and final piece of data that is utilized to measure the breadth of the market. Fig. A 10-day average of stock market upside volume, dark line, versus downside volume. A strong market should have more upside than downside volume. The ARMS Index. The ARMS Index, named after its creator Richard Arms, is a ratio of a ratio. The denominator is the advancing volume divided by declining volume. A reading below 1.0 indicates more volume in rising stocks and is positive. A reading above 1.0 reflects more volume in declining issues and is negative. On an intraday basis, a very high ARMS index reading is positive, while a very low reading is negative. The ARMS index, therefore, is a contrary indicator that trends in the opposite direction of the market. It can be used for intraday trading by tracking its direction and for spotting signs of short-term market extremes. See Figure 18.7. TRIN versus TIC. TIC measures the difference between the number of stocks trading on an uptick versus the number trading on a downtick. The TIC is a minute-by-minute version of the daily advanced decline line and is used for the same purpose. FIG, the ARMS index, also called TRIN, trends in the opposite direction of the market. Exceptionally high spikes usually signal market bottoms. A 10-day moving average of the ARMS index is a popular way to view this contrary indicator. Smoothing the ARMS index. While the ARMS index is quoted throughout the trading day and has some short-term forecasting value, most traders use a 10-day moving average of its values. According to ARMS himself, a 10-day average of the ARMS index above 1.20 is considered oversold, while a 10-day ARMS value below 0.70 is overbought, although those numbers may shift depending on the overall trend of the market. ARMS expresses a preference for Fibonacci numbers as well. He suggests using a 21-day ARMS index in addition to the 10-day version. He also utilizes 21-day and 55-day moving average crossovers of the ARMS index to generate good intermediate-term trades. For more in-depth treatment, read The ARMS Index, TRIN, by Richard W. ARMS Jr. Open ARMS. FIG. The 10-day Open ARMS Index gives a much smoother look to this indicator, but still trends in the opposite direction of the market. A crossing of its 10-day moving average darker line often signals turning points. EQUIVOLUME charting. Since technical analysts combine price and volume analysis, they have to look at both parts of the chart at the same time. On the equivalum chart, each price bar is shown as a rectangle. Heavier volume days produce a wider rectangle. Lighter volume days are reflected in a narrower rectangle. FIG. Equivalum charts combine price and volume. The width of each rectangle, daily bar, is determined by the volume. Wider rectangles show heavier volume. The rectangle started to widen during Intel's last sell-off, a negative sign. As a rule, a bullish price breakout should always be accompanied by a burst of trading activity. In an uptrend, for example, up days should see wider rectangles while down days should see narrower rectangles. Candle power. In a 1990 article published in Technical Analysis of Stocks and Commodities magazine entitled East Meets West. Candle power charting. Morris proposed combining candlestick charts with ARMS equivalum charting method. Morris version shows the candlestick chart in an equivalum format. In other words, the width of the candlestick is determined by the volume. FIG, a candle power chart, also called candlevolum, combines equivalum and candlesticks. The width of each candle, daily bar, is determined by volume. Comparing market averages. FIG, the Nasdaq S&P 500 ratio tells us whether technology stocks are leading or lagging the market. It's usually better for the market when the ratio line is rising. FIG, an overlay comparison of the small cap Russell 2000 and the large cap Dow. It's usually better when both lines are rising together. Conclusion. Conclusion. A Dow theory buy signal is present when both averages hit new highs. The general rule to follow is that the greater the number of stock market averages that are trending in the same direction, the greater the chances are for that trend continuing.